Hello everyone and welcome to another episode of the Smart Money Show. I'm one of your hosts and your only host today, unfortunately, Ali Suleiman. My co-host Naman Akhtar, unfortunately, isn't sat across the table from me as usual. He's caught up with some university commitments, which is absolutely okay. But we're also joined by our head of FICC at the show, Wahy Yahya, for another economic recap episode. Now, normally I also say that we're joined by our head of equities, Dylan Eilert, but also, unfortunately, he's caught up in some grad applications, so he's going to be not with us, unfortunately, for this episode, but he's sent over some information that I'll be covering when it comes to US macro. But before we get into all of that and onto a more FICC focused, to a fixed income, currency and commodities focused episode, I'm going to hand over to Wahy and just kind of ask him how he's doing. So Wahy, good to have you back onto the show. How's things been with you over the past sort of month or so?
Yeah, everything's been really good. Thanks for asking, Ali. It's been a pretty choppy month. We've got a lot of things to cover today, but looking forward to see what the rest of the year has got to hold.
Yeah, absolutely. And I'm excited for a more focused episode because definitely been a variety of stuff that's been happening. And we're going to actually cover the whole broad scope of the team right now, which is not just fixed income, which we focus on a lot, but also currency and commodities as well, and the wider sort of macroeconomic lens of how it all affects that. So I'm very excited for that for sure. But how's things going with your team? Obviously, we've had a big hiring sort of rush happening, which is closing off hopefully in the next week or so. But how's your team looking and how excited are you for articles to start getting put out again?
Firstly, a huge congratulations to anyone that made it to the first or second stages, whether it be FICC, crypto, equities, journalism, macro, whatever team you applied for. A huge congrats from me because it is not easy. We've had a large volume of applicants as well. So your time has been greatly appreciated. When it comes to my team FICC, the stakes have been pretty high. I'm not gonna lie. We've had a fair few of applicants. What I would say is whether you're applying to be a part of the team or not, communication is the most important thing, which is what I'm looking for. Communication. It's a pretty voice-based role, being in the FIC team, as we cover so many different things, as opposed to just one specific asset, right? So communication is key. Working as a team and constantly being inquisitive. If you're naturally inquisitive, then this is the place for you. Which is why we're willing to take on people from various different backgrounds. We're looking for real diversity here, with regards to knowledge, backgrounds, and even just academics as well.
Hmm. Absolutely. And it's been weird to sit on the other side of the application process as well. Obviously, you and I, we've gone through many application processes, whether it's spring, summer, and obviously what we're in now, grad applications as well. So it's been cool. We've definitely had a few learnings on our side as well. And as you said, we've had over 200 applications for the research analyst positions across all four writing teams, crypto, equities, FIC, and macro. And that means over 100 interviews as well. So it's been quite crazy the past month or so. But still, we've managed to stay commercially fluent and aware, and we're able to put together an amazing episode today. So normally, I'd hand over now to Dylan to discuss US macroeconomic data, but unfortunately, we're not joined by him today. So he sent over a few things which we're going to go over, or I'll try my best to go over and match his rate of pace and his rate of knowledge that he usually gives off in the episode. So let's kick off with the US before I hand over to Wahy for the UK. So with the US, things still look solid, though the undercurrents are a bit more complex than before. The economy, it grew quite strongly last month, but the latest estimate puts annualized growth at 3.8%, which is actually up from earlier readings, so good news. That revision came mainly from stronger consumer spending and a sharper drop in imports, showing the rebound had a bit more depth than we originally thought at the show, as well as other organizations. So on inflation, headline CPI is sitting at around 2.9% year on year, but core inflation, which obviously strips out food and energy, is closer to that 3.1%, which means price pressures are still there even if the direction is improving slightly. The labour market, though, is looking a little bit softer. The unemployment rate is about 4.3%, and some private job data have shown job losses in recent months. It's not that alarming yet, but it does add that little bit of uncertainty that the US market doesn't really need right now about where hiring is actually headed next for employers. So, given all of that, the Fed finally made a move in September. They trimmed rates by 25 basis points, bringing the target range to between 4 and 4.25%. That was their first cut this year in September 2025, and markets have had a bit of a mixed reaction since. After the inflation numbers came out, we saw the S&P dip a little bit, dip a touch as we'd expect, but this just shows just how sensitive sentiment actually is still to every data point that comes out of the US markets and the US economy. So overall, growth is still hanging in there, but inflation hasn't eased as quickly as hoped by Donald Trump. And the job data is sending mixed signals. So, with the Fed now easing, investors are watching closely to see whether this is the start of a broader shift or just maybe a single adjustment before the data settles again. Although I think there are a lot of opinions out there, including ours, that might be combating that. So, that's the backdrop heading into next month and into the final quarter of 2025. Steady growth, cautious optimism, and plenty of room for surprises. Now, that's a very, very brief overview of what's been happening in the US market and the US macroeconomy. And as I said, Dylan would normally do a much more in-depth introduction into what's been happening. And as I said, we always like to kick off with macro because we think it tries to actually paint the picture or give the frame to the picture that we're trying to paint throughout this episode, which means I'm going to hand over quite nicely now to Wahy to discuss what's going on in the UK.
Yeah, so in contrast, we're going to look at the UK right now. The UK economy is continuing to crawl ahead. As always, we like to look at the growth, the output of the economy here. So we're looking at the second half to expand modestly, which is reflecting services, support, while manufacturing, construction, and industrials remain weak. So over the second half of the year, growth is likely to only come to 0.6 to 0.8%, meaning that on the full year basis for 2025, growth is expected to land somewhere near 1.1 to 1.3%, which is in line with our expectations from the IMF and the OBR. So growth is being driven less by consumers here. They're increasing in their caution and more by net exports, government support, and residual business investment, even though this is quite subdued at the moment. Moving on to inflation here, inflation is being quite stubborn. Headline CPI is expected to peak at about 4%, and after that, it may begin to soften, but only gradually. And through Q3, inflation likely stays between 3.8 to 4%. By Q4, this might ease slightly to around 3.6 to 3.8%. Now, when we look at this, we're looking at the challenge of core inflation here, which excludes the volatile items like energy and food, for example. And that's expected to linger at around 3.5 to 4%. And this is driven by services. And when we talk about services, we're talking about rent, leisure, healthcare, and other things like wage growth as well. Now, when it comes to risks here, we're looking at sudden spikes in energy prices or even utility costs increasing as they're getting passed across household bills as well. Moving on as well, we look at households, and they're feeling quite squeezed at the moment as mortgage rates are very high. We don't usually talk about mortgage rates, but I thought that this is the perfect opportunity to talk about it. So household spending is expected to be muted going into H2, and this also goes in the fact with retail sales being broadly flat, with a little room of upside as well. This also means that discretionary spending, such as your non-essentials, may stabilize later on in the year. And finally, the savings rate is creeping. It's creeping as well, suggesting that many households are being more cautious. Given the mortgage rate is so high, it means that the willingness to want to actually spend has decreased. So this means that they put aside more money for, you could say, a rainy day, rather than spending it as well.
Hmm. Amazing. And it's always, as I said, always good to kick off with macro stuff because I think we've got some niche topics coming up, but especially the next one actually as well, which we'll go into very soon, that complement this macro reporting that we're doing at the top. But before we move on, have you seen anything that kind of changes the Bank of England's outlook? Have you seen any kind of subtle reporting from them, or just what's your opinion of what you think the Bank of England is thinking right now?
That's a really good question, and I'm going to say quantitative tightening here, meaning that it's letting the holdings of government bonds run off or be sold back, and this, as a result, leads to an upward pressure on the longer-term gilt yields. And because of this, long end gilts, which means bonds with longer maturities, when we talk about the long end here, that trading levels that we haven't even seen in many years, which reflects this elevated long-term yield expectation that we have. So definitely, it is something to look at. It is something to watch. And we are looking at the US and China as well as they're slowing down quite sharply. You've got trade tensions as well taking place, which could drag UK growth at the same time. So yeah, really, really good question, Ali.
Yeah, absolutely. And I think it's a great segue to move on to our next section, which is the start of the FIC specific topics. And as I said, this is obviously going to be a bit more of a FIC focused episode, which I think for this month might actually turn out to be a good thing. So, the topic that you wanted to start off, Wahy, with is shadow banking. So, for our listeners and viewers and just our wider audience, why don't you try and explain what shadow banking actually is for those who don't know or don't know too much about it? And why has that been in focus recently?
Sure. So shadow banks are private credit funds, direct lenders, or other non-bank lenders. And the reason why it's been creeping up recently is because they can now finance a huge record volumes of UK corporate debt. Now, this growth here was fueled by the long period of ultra low interest rates. We're looking at 2010s to early 2020s. Corporates found private credit attractive as it was faster, more flexible, and less regulated than traditional bank lending. So regulation after 2008 pushed banks to hold more capital and reduce their riskier lending, and this then created a gap that shadow banks filled, especially for mid-sized corporates and leveraged buyouts as well. Now, the current UK angle, seeing as that we're talking about this now, is that the Bank of England has recently flagged the shadow banking system as a systematic blind spot, which highlights the vulnerabilities in private credit and money market funds. The UK corporates are now relying heavily on private credit, and it's been more exposed in terms of investor sentiment if it decides to turn as well. And now, when we look at banks, the valuations currently look cushioned and more safe. So we always refer back to this term, safe haven, right? So we're looking at a more safer image here. But if shadow finance triggers wider stress, then that cushion could evaporate fast. So while we do know that a benefit may come from it, we need to evaluate the risks that come with it as well.
Amazing, great. Well, so I actually didn't know too much about shadow banking apart from what I learned in A level economics. So I'm glad that it's kind of been brought back into focus a little bit now as well. So what risks or vulnerabilities are regulators and markets most concerned about now that it's come back into kind of headlines?
We're looking at liquidity risks being played here. And this is because shadow lenders don't take deposits like actual banks do. Instead, they raise money from investors. So you've got pension funds, insurers, or even higher net worth individuals. But here's the catch: investors can redeem quickly, but the loans shadow banks make are usually long term and illiquid. And this mismatch here means that markets have a lot more stress induced, which means higher defaults, maybe falling bond prices, and redemptions as well. This leads to funds being forced to sell assets at fire sale prices. And if anyone doesn't know what fire sale means, it's when a sale happens and it's extremely cheap compared to what was usually being advertised. And this therefore would amplify more volatility. Now, this risk is similar to what regulators flagged during the UK gilt market turmoil in 2022, where the pension fund LDI strategies were forced into forced selling um, through the whole fire sale thing as well.
Interesting. And the fire sale sort of mentioned that you mentioned that again came up really a lot when we were studying crisis in A level economics. Again, I'm bringing it up, but also it's a phrase that a lot of our listeners and viewers, I'm guessing, but I know speaking for me and for Naman as well, if you were here, we hear that a lot in financial Hollywood. Sometimes in these movies, you hear the words fire sale a lot, and it's especially used in those. I think the one that comes to mind is in Margin Call with Kevin Spacey and Jeremy Irons, I believe. A brilliant film, really, really good film.
Amazing
And
film,
this,
amazing
yeah.
film.
And it's basically, I mean, they don't say it in the film, but that bank is basically Goldman Sachs, right? And they talk about fire sales a lot, and it's a great film because I think it's the most accurate about what it would actually look like on the trading floor, the way they discovered it, and also the way they would they were able to protect themselves from it, but also the reality of what it looks like. But yeah, as I said, fire sale we mentioned a lot there, so it's scary to hear that. I assume in reality, and especially in today's day and age. So could stresses that we're seeing here within shadow banking, could these stresses and, as you said, liquidity risks and whatever else might be attached to this, could it spill over into the broader financial system? Is there a validated worry for our potential audience and for the wider sort of players within financial markets to be worried about?
I'd say it acts as a double-edged sword, actually. We're looking at UK banks as well when we look at the wider holistic point of view here. When it comes to short-term pressure, for example, fee income would be hit because corporates bypass traditional bank loans for private credit in this case. When we look at valuations, for example, banks trade with something called a safety premium, which means that their balance sheets are better capitalized, more regulated, and stress tested. So investors would now view them as more safer than fragile shadow lenders. But I guess when we talk about risks as well, for the broader holistic point of view here, systematic risk is a big thing. You know, if shadow banks crack under pressure, then it can spread quickly to the broader financial system, which means that bank funding markets could seize up, as seen in 2019, where we had the US repo market stress or the mini crisis during COVID, as we all know, which we've actually lived through in March 2020.
Yeah, absolutely. I was going to mention that as well as a follow on. So it is something that's readily available in terms of actually referencing history and stuff that's happened. And as we always hear in financial markets, history doesn't often repeat, but it does often rhyme. And there's a great book by Ray Dalio where he basically has been able to predict market cycles by just looking back in history. And he really goes back thousands of years. I think he mentions Greek and Roman times. So I think it's called Mastering Market Cycles, or the World Order, or something like that rings a bell. So definitely check that out to our audience who are interested. But Wahy, I think we've done that topic and beaten it to death. So I think let's move on to the next one, which is about BP Energy. Now, it's not something, if anything, it's something that you expect Dylan to maybe talk about, whether it's mentioning their stock or something. But they obviously have a big part to play within the FICC sector and that space. So what's the latest story around BP and the broader energy sector, and why did it creep into your topic list for this episode?
Yeah, no, it was definitely something different, as we all know that Dylan does cover the equity side of things. But no, when we look at the commodity side of things, as commodities comes under FIC, BP actually stood out, and I'll tell you why. It's because the energy outlook for 2025 assumes that global energy efficiency improves roughly 2% per year, which essentially caps the long-term oil demand. That's what BP said. But the recent data says otherwise, as efficiency gains are slowing, which means that the actual figure is closer to 1.5%, especially across aviation and shipping, where tech upgrades are a lot harder. And BP has pushed back the peak of oil of their oil forecast to around 2030, where demand may potentially be reaching 106 MBD by 2035. This is only if the efficiency becomes weak. Um, and I think when we talk about commodities here, we also have to relate it back to how markets would react as well. So the market implications of this is that oil demand would be higher for longer. Crude prices would be supported, and cash flows would be a lot more stronger in this case. When we talk about the credit market, however, the BP's debt, if the transition is smooth and demand stays firm, the spreads could tighten as the cash flow may fall in terms of its risk. And as anyone would do when it comes to investor sentiment, you're always going to focus and prioritize ESG. So the ESG narrative of this is that investors may press for lower hydrocarbon exposure, but the resilient energy demand will prop up valuations and slow the urgency of divestment here in this case for investors.
Yeah, I haven't heard hydrocarbons since GCSE chemistry, actually, which is a pretty mental, fractional distillation and stuff. I still remember it a
Fractional
little bit anyway.
distillation.
A little bit. But okay, Wahi, interesting. I can see why you brought it into the topic list. But what does this mean for other energy linked assets? And also, you briefly mentioned it, but what does it mean for investor positioning as well?
Sure. So I'm gonna focus on the upside in this part here. So slower efficiency gains tends to lead to higher oil demand and stronger returns. That is what investments want. That is what they think should be good, especially from an ESG standpoint as well. However, the downside in this case is the reputational pressure and the stranded asset risk if policies change or technology suddenly accelerates, and they transition a lot more quicker than what we would have expected.
Okay, interesting. As I said, definitely can see how it creeped into the topic list, and you don't actually think of it sometimes when you're looking at a company about the effects it can have onto different spaces as well. I mean, obviously, it's not going to have an impact on crypto, for example, but that's why we focus on FIC and equities on these episodes, because we think those are the most important to be commercially fluent on, and those are the ones that will help you succeed in those crucial interviews for our audience as well as for ourselves as well. Brings us nicely onto the currency side of things. So Euros rally. We don't talk about currency a lot, especially euro actually on the podcast, but I'm glad you highlighted it this time around, Wahi, before we go on to commodities, and obviously we're going to talk about gold later on. But why don't you talk to me about what triggered the euro rally in September? What were your sort of ideas for the reasoning behind that?
Sure. I mean, You are right in this case. We have spoken a lot about commodities and fixed income and not really had much to talk about when it comes to forex markets. One thing that I wanted to add was that forex trades around $5 trillion a day, so I think it does deserve its mention
Yeah.
in the recap episodes, which is why I decided to give it some justice in this case. But no, really good question here. The euro has shown real upside momentum lately, and this is underpinned by expectations that the US dollar is under pressure and that the Fed will ease more aggressively over time, as you stated in the macro section. Now, several banks now see Euro USD crossing the 120 threshold. We call it a threshold with a handle if you want to refer to it as that. Um, and this is going to be reached sometime early to mid 2026. So, in terms of the nuances here, UBS, for example, have bumped their projection for Euro USD, and it's now seeing that it may reach 123 by June 2026. This was up from the 120 handle levels, and this was according to the forecasts that were publicly given as well. JP Morgan, on the other hand, their forecasts do align. They expect 1.19 by late 2025. 120 might happen in December, and 122 by mid 2026. Now, I'm throwing a lot of numbers here, but I just wanted to highlight the fact that Euro's recent strength has tied into market positioning as well. So this means that some investors are now actively looking to diversify away from the concentrated dollar exposure. From the eurozone side, the current account balances have seen modest improvement, which then supports foreign demand for euros as well.
Yeah, and it plays quite nicely into the narrative that we've been putting together since you've been appearing on the show, Wahy, and also the articles that your team of analysts have been putting out, which is de-dollarization. It's a real thing, and it's coming, and it's coming hard, and it's coming strong, and this is another sort of topic that adds to that. But was this move more about ECB policy, Wahy, or was it more about US dollar weakness? I assume it's a mixture, but if you had to pinpoint it to one, or maybe if you want to discuss kind of the dynamism between both of them, what do you think it really caused it?
That's a really good question, actually, and I'm going to say it's a mix. And factually, it's true. The ECB rate easing and Fed cuts as well is critical. And if the ECB moves too slowly or inflation surprises upwards in Europe, then the euro's upside could be capped in this case. So I'm gonna say it's a mix. You've got external shocks as well that play, such as energy. Which is also a real risk for Europe as well. And so, in the case where the spike in energy occurs, this could hurt the eurozone growth and sentiment. May also erase some of the gains here in this case. So yeah, it's definitely a mixture between rate easing and Fed cuts happening at the same time between the Fed and the European Central Bank.
Hmm. Yeah, and you mentioned market positioning, and obviously we don't give out financial advice, but what are your kind of thoughts on how you position in this market? About kind of how would you position around the euro heading into Q4 all the way to kind of Q2 2026? Just eager to hear your thought process around that. What do you take into account?
So I actually take Euro USD, in my opinion, as a safe haven asset, which means that I'm currently still holding on my positions given what's happening. And in fact, we're profiting from it at the moment. This is by no means financial advice, of course. You are free to do whatever you want with your investments. But me personally, and also in the FIC team as well, we place a big, heavy emphasis on Euro USD and cable with our dollar exposure. Um, and it is supported because when we look at the caveat here, not everyone is going to be bullish. So, for example, Wells Fargo is more cautious in this case, and their warning is that Euro USD may stall and may reverse with a possible drop towards 1.12 by mid to late 2026. Now, what we tend to do with our analysis is we take this on board, we combine it with other fundamental factors as well as the technicals. And if I was to hear something like what Wells Fargo does, as opposed to UBS and JP Morgan, I'm gonna take the more broader opinion here. See it more holistically, align it with the technical views, and I'd still hold. This again is in my opinion. But if we do decide to see a reversal, then we may change our stance to be bearish. But at the moment, no, we're looking at Euro USD continuing to rally going into the late portion of this year.
Absolutely. And I'm going to take this opportunity to maybe give you the chance to do a shameless plug, Wahi. But obviously, you mentioned the portfolio. So, I need to let our audience know because we haven't officially announced that. And this isn't really an official announcement either. But almost like for those who have stayed this long, a little secret insight into what we're planning. So, talk about the portfolio that the FIC team and also obviously equities and crypto are doing. But that's a separate thing. Talk to me about that with the FIC team.
So it's been in discussion for a while here that all teams should put their analysts through something called a trading simulation or a demo portfolio, where they get to actually trade and make live market decisions that we can then use for our own research. And I think it's beneficial because it gives everyone the exposure or as close of an exposure as they can to what real world trading actually is. One thing I've always stressed to my team is when you have this capital being allocated to you, trade it as if it's your actual money. You want to trade it as if you have good risk management, you have good investor sentiment that's happening as well in the background when you're looking at fundamentals, and your technical should follow as well. The reason why we've done this as well is because we believe that the data that we use in our articles, if we were to have our own charts and figures to then follow through, it would make a lot more sense. And we would also have our own returns on display as well to show that yes, while we are giving advice on our side of the markets, it may not be financial advice. However, these are the risks that we decided to take on board as well. And I think it was a really good opportunity here. And FIC is taking a lot more of a different approach as opposed to equities and crypto. We're taking on more of a front office, vocal, short term trading approach where I'm allowing my analysts to trade anywhere between the 1 minute time frame to then even trading the daily time frame as a max. So you are free to trade how you want. You are free to swing trade if you feel by holding positions on for a long period of time, or you are free to trade on the 1 minute basis. What matters the most here and what I'm looking for specifically are three things. I'm looking for risk management, I'm looking for percentage returns as opposed to nominal values, and I'm also looking here for psychology. I think psychology is really, really important. I want to see how my analysts can actually be put through market conditions. For example, when PMI results come out and it doesn't fall into your favor with what the market has priced in, if you were in line with consensus, how do you react? What does your psychology do? And how do you interpret what's happening with the market in that moment in time?
Absolutely, and I'm glad I asked you about that. And it's one of the reasons why we've pushed so hard with our hiring, and one of the reasons why we pushed so hard to actually bring people onto the team and on board is because while we can serve our community externally, serving our community internally within the team is as important as well. And a couple of reasons, extra reasons above what you also mentioned, Wahi, just now about the portfolios within the teams is that we're also going to try and integrate these portfolios into our website. So we want our listeners and viewers, our audience, we want you guys to be able to actually see our performance, our team's performance on the website. Now they might not like this as much if the if the performance isn't as good, but we want to be fully transparent as a non-profit organization that we are completely student run, and this data and charts that we're going to be getting and using within these portfolios are going to be integrated into the articles as well. Because right now the articles are great, but sometimes they use information from external sources, which means they're subconsciously skewed towards wherever that information came from. So that's how we solve this problem, by making sure we're 100% student originated, which is exactly what we are about as an organization. But Wahi, we've gone on a little bit of a tangent there, which is absolutely fine. It is FIC related, of course, but it leads us quite nicely onto one of our last sections of the episode today, which is about, obviously, surprise, surprise, gold. Now, it has blasted through $3,800 per ounce. So why don't you talk to me a little bit about what pushed gold to break through this sort of barrier that a lot of people maybe didn't expect to happen?
I think it's a full circle moment here, as my first ever appearance on the Smart Money Show's recap episodes was discussing whether or not we thought gold was overstaying its welcome, which was a fantastic article that was written by Hamza, again from the FIC team. And overall, we were very, very cautious, but we also did stay within our positions. And just to talk lightly on this as well, gold's rally has picked up a lot of steam. It's broken the 3,800 handle, and it's extended its gains as markets digest physical stress, dollar weaknesses, and renewed safe haven flows, which means that we're looking at more inflows coming into those safe havens as investor sentiments are looking to be a lot more risk off as opposed to being risk on. And when we talk about the dynamics in this case here, we're looking at central banks continuing to be big buyers of gold. And for example, in Q2 2025, as I mentioned previously, they added 166 tons to reserves, which underlines their persistent appetite, as I like to call it. They have a large appetite for this. When we refer to the smart money in this case, bar and coin demand has also surged as retail and as individual investors chase this momentum as well. And now for forecasts, when we look at smart money themselves, Goldman Sachs now expects gold to reach the 4,000 handle by mid 2026, which is, it may be a bit too high, but I don't doubt that gold will hit that mark. And it's looking to future raise that target to 4.9 by the end of 2026. So we've got big projections that are coming in. And I think one question I'm asking the team here and myself is: are we going to be in line with consensus, or are we going to differ from consensus, and why? I think it's really important to understand why the street think why they think that, but it's also important that if you follow the masses and something doesn't play to your favor, which relates back to the whole demo portfolio as well, it then doesn't look good for your percentage returns. Which is why I think in this case we're going to be, again, no financial advice in what I'm about to say, but we're looking to close our positions and potentially look to reduce our risk, and cover it with how much we've made. But no, it's a really interesting thing. As you know, you've got JP Morgan, for example, with a lower target at 3.6, and they may potentially increase that to 4,000 as they go into 2026 as well. But I think what they've done here is they've also factored the fact they've also factored that if the Fed delays cuts or signals, and they lean towards being more hawkish, then the dollar may strengthen, and this could underpin gold's potential to be going to the upside in this case, which is one big factor that we should also consider. As gold, essentially, it doesn't always do this, but historically, it tends to feed off of dollar weakness. We call it the dollar strength and weakness cycle, as you may have learned in economics as well. But yeah, no, it's really really interesting.
Absolutely, and it's the reason I wanted to end the episode with this topic is because it's so broad, and of course, safe haven. So everyone's going to be talking about it. You've kind of touched on two of my questions, which we can deep dive into more now. So obviously, we'll save investor positioning, or as you said, the consensus. We'll save that for a bit later on. But I want to understand. I mean, you mentioned the Fed, you mentioned the dollar. How much do you believe this move in gold was macro driven versus just kind of technicals?
Really good question. And I'm going to say it acts as an intersection here between political hedging and monetary hedging as well. Not so much technicals, as I've already outlined that we had our support and resistance that were already marked out between the 38 to 400 handles. Um, and I think in this case, technicals don't really matter as much as, like I said, the intersection between politics and monetary hedging. It acts as like more robustness that allows for speculative metals um, have a path that technicals may lack in this case. So I wouldn't strictly follow the technicals in this particular scenario. I think I would lead more onto the fundamentals. But like I said, this is a personal opinion. It's not the gospel here in this case. So as we always say, take everything with a pinch of salt. I think the FIC team are looking to expand our portfolio, as we've mentioned more about FX. We are currently looking at increasing our dollar exposure and possibly going into more of the exotics, and kind of factoring away from being more risk on to being a lot more risk off.
Hmm, absolutely, and it leads me really nicely onto my last sort of question for the episode, and it was going to be a little bit about personal positioning and obviously your team's positioning, but you've answered that quite thoroughly. There was something that I want to pick up in your first answer to my question about gold, which was you mentioned about how GS is predicting 4K of gold in 2026, whereas JP right now is saying 3.6. How does an investor, let's say yourself, for example, or anyone, a retail investor, how do they kind of squabble with the fact that these two giants are quite different in their forecast for the asset for the market, and how can you sort of explain to our audience how they can navigate that? Because obviously gold, safe haven, GS and JP Morgan are safe haven firms, for example. So how does someone kind of reconcile the difference between that, and how do you navigate that? Because consensus is a big thing, but there seems to be a lack of it if there's such a big difference between these two firms.
Yeah, there is. it's really important that we actually understand how this even happens in the first place. How do we come to our targets that banks make? And essentially, it comes from analysts themselves. They factor up both fundamental analysis and technical analysis, and they also factor what the rest of the street are doing as well. Now, banks vary bank to bank with regards to how much risk exposure they want to put on, which is reflected in their target prices, as it's publicly given as well. But I mean, as an investor, you'd want to know why they come to targets like this. And in my opinion, I think I put it down to them cutting out all the noise and seeing what other investors have done historically. They do factor in seasonality as well. Seasonality charts are definitely looked at, as well as historical price movements. Like I said, factoring in those technical indicators, but also the experience that actual traders have on the desk themselves. It plays a huge role. Now, a lot of the traders at these banks may have had many years of experience, as we've had a few guests on the Smart Money show. I think that when they factor in what they've seen previously, with both recessions and major catalysts as well, when they factor in all of that, they then come to that target price. And I believe that investors can actually put trust in that target price, and potentially look to have their assets in safe hands when they put money with these firms.
Yeah, amazing, Wahi. So thank you so much for joining us for this economic recap episode. I know it's it might have been a lot to prep and talk about for this FIC focused one, but I'm also really looking forward to articles, newsletters, short form videos, the demo portfolios, everything to be launched after this hiring round to kind of even further showcase what the FIC team's been doing super successfully. Once you get all of your new hires as well. So for our listeners and viewers, I hope you enjoyed that episode and learned as much as I did from Wahi and from the topics that we covered on the show. So if you are watching us on YouTube and for some reason you haven't subscribed already, then I'm sure Wahi has given you an amazing reason to do so. And same goes for you. If you are listening to us on any audio platforms, you can leave us a rating and a like and a follow too, as well as leaving a comment on either platform to let us know if there's someone that we should be speaking to that we haven't spoken to yet on the show, or a topic that we should cover on the show that we haven't covered yet. And please do get in touch. Absolutely, if you disagree with some of Wahi's comments, I'd be very happily to get those over to him with maybe a little bit of extra exaggeration on them as well. But as usual, thank you so much for watching. We will see you next week for another episode of the Smart Money Show. Please do show some love and engagement on our social media platforms as always. But until then, take care and stay tuned. Thanks.